How you doing, folks? I'm Mark Dutram with BayView Private Wealth. We're coming to you with another episode of BayView Views. Today, we're coming to you amongst market volatility. And we're going to talk about, one of our factors being price, and so important. We're going to talk about that PE ratio and what drives it and what's determining, again, the values that it's determining in price. So, again, very important, especially how we invest, and I think very valuable for you guys to actually look at, especially today. So we're going to take a kind of a snapshot of where the market is today. And again, this is through today. We're down about 24% on the S&P. NASDAQ's off about 33. So the market clearly in bear market territory. And so what's driving that? Again, we know the Fed is raising interest rates. There is no absence of things to worry about in the economy today. Can they orchestrate a soft landing? Do we have a recession? We've got a Ukraine war going on. We've got high energy prices, many things. We've got midterm elections coming up. So all of these things are weighing on, again, a market that is a forecaster, right, guys? So will the market be back before the economy? The answer is yes, right? So just like the market went down prior to, again, the economy going down. So we just shot a video about that, about market timing as well. So lots of things to worry about. And again, this very famous PE ratio. Remember, Warren Buffett, a very big fan of price, what you pay for a security. So we'll talk about that today because, again, when we look at this formula, this PE ratio, we have the top, which is earnings, right? And so that is the expansion of the growth capability, the cash flows, the earnings generation of a company going forward, right? We're buying future earnings, we're paying a price for it today, and then we're discounting that back. And so what is a discount rate? Well, the discount rate in simple terms would be what you would expect to earn on a particular investment. And so in this case, in securities, what we'd want to be compensated for the risk that we're taking in the market, right? So the discount rate actually has two parts to it. It has a tax-free rate or what we call a risk-free rate, and that is basically short-term government bonds, what we would invest in a very safe investment, and then a risk premium. And so that risk premium would be, what we would expect to be compensated for investing in something of greater risk than a government security. And so when we look at the PE ratios today, we see that it has a relationship to the discount rate. And so what is actually driving, these markets that we see today? So when we see this very simple formula, we know that if earnings go up and the discount rate goes down, which is what we've seen probably over the past, 10 years, right? Very strong earnings, interest rates at essentially zero, could justify, again, these very high prices that we're seeing in the market today. Well, now we're seeing a little bit of the reverse of that, right, guys? We're seeing now, is it earnings? Are we seeing a big decline in earnings? Or are we seeing a big increase in the discount rate as we look a little bit more? So the Fed, again, raising interest rates to try to tame inflation, trying to intentionally, slow down a very strong economy, essentially, is what's happening. And so we can see then anything that's going to make this a smaller number, again, earnings going down or the discount rate going up, is going to justify a very smaller price in things. What I want you to see is this, though. As prices go down, the expected rate of return goes up. And I'll kind of share that with you, and that might not make sense to you right now, but we'll look at that. So again, in this formula, earnings, has it been earnings? Has it been the E or the R that's really kind of driving this price discount? So if we look at this right here is 2020, right? So we had COVID happen, earnings dropped off significantly. This is 2021, this is 2022. And guys, we can see this. This is a tremendous slope of earnings over time. And these are expected earnings going forward. So if we look today, this is, again, earnings growth this year. So it was growing quite steadily, and now it's essentially plateaued at where it's at. But it's, again, about 5.1%. positive, right? So it's not necessarily that earnings are going down, although, again, the forecasts have come down some. Most of it has been the multiple decline, right? The amount that we're willing to pay for $1 of future earnings. And you can see that multiple is off about 29%. So earnings have been up. So that we looked at the E, right? So, and then we saw, again, earlier this year, again, very high multiples that we see for large cap growth. Those are NASDAQ type of stocks, very expensive on the multiple, and still would be quite expensive today. So what we focus on, again, is small cap value, which has the size and the price premium built into it. We can see that, again, those are at really still some attractive levels from a historical standpoint. And then if we looked at the market, the S&P 500, again, this is a historical average. And again, this is where it's priced today. So we know that from a PE ratio, it is actually trading at a pretty good price. And why does that matter? Because remember, what we pay for something really determines what we're going to get out of it as far as an expected return. So this is something called regression analysis, which does a great job of comparing the relationship between two variables. And so all we're going to do in this is a 1 year, and then this is a 5 year. So we're going to look at a 5 year because it's got a little bit higher R squared to it, meaning that we can depend on the data a little bit more. But this is looking at 5 year annualized returns. This goes all the way back to 1997. So basically what we're going to do is we're going to say, hey, what we pay for a security today, that's going to be our independent variable, right? And then we're going to see what is our expected return, then the dependent variable based on that price. And this is really important because we had a lot of people in January that would say, hey, I want to add money to the market. It's doing very well. But if we looked at the prices in January, we were probably priced right around here, maybe around 21, 22 times earnings. And if you can look from this simple regression chart, you would see then that your expected returns for the next 5 years would be essentially flat because you're paying a lot for that security. And think about anything, whether I overpay for real estate or commodity or any type of asset like that, it's going to determine how much I get out of it. If we looked at today, and again, this is through September 30th, so we're right around this point somewhere. Again, we're paying at around 15 times. If we look at our expected 5 year annualized return, now we're back to normal market returns of about 9% annualized. As a matter of fact, if we just got back to where we were at the high in the beginning of the year, I think we'd have to average somewhere around 12% just to go back to where we were before. So guys, the prices are off. A lot of it, remember, is determined by the Fed raising interest rates and the market pricing in whether it does that successfully. So I hope this helps, again, in kind of breaking down that PE ratio and the fact that, the markets today are priced in almost all respects, whether we look at the CAPE, whether we look at, again, PE ratios forward or rearward looking, the Buffett indicator, all of those say that the market is actually either fairly priced or underpriced. So again, we hope this makes you better investors. We hope this makes you, again, kind of navigate the markets more effectively and especially thinking about price. So thanks for watching another episode of BayView Views. Happy investing, guys. If you have any questions or anything, please give us a shout. Hope you have a great day.